Mortgage interest rates, where will they be in the next several quarters into 2024? I believe that we'll see mortgage interest rates remain relatively high meaning where we are today. Long-term 30-year fixed-rate mortgages are in the 7%. I think that they're going to stay in that range. They could go even a little bit higher still, maybe to 8, possibly. Why? Where is the market taking it? Well, we have to look at the recent events. I'm talking about the last several years, really going back to 2020, COVID, and all the stimulation that was put into the monetary system to save the economy from the COVID shutdowns. All that trillions of dollars went into the economy and caused, for the first time in 40 years, upside inflation. Yeah, inflation out of the genie bottle for the first time in 40 years. And inflation is not a good thing for the general populace. People can't make ends meet. And so the job of the Federal Reserve, Chairman Jerome Powell, is to bring inflation back down, price stability and employment stability. Well, employment stability is strong right now, but it's the price instability that's causing a lot of havoc in the marketplace. So the Federal Reserve raised the short-term, that's what the Federal Reserve controls, short-term, not long-term, but short-term interest rates, increased them over 500 basis points, or over 500% essentially, in the last 15 months. That's a massive change, really unprecedented rate of change in history. It's not the 5 percentage points that it went up, but it's how fast it went up and the overall 5x times rate that's causing effects on the marketplace. This instability, in other words, the marketplace doesn't know where things are going. The instability, the volatility, if you will, is what causes long-term investors, institutional investors, who are always looking for where to get their best yield return on the capital. It's pension plans. Public and private pension plans across the country have to try to find a yield to pay the pensioners. Where do they go? Well, typically they go into equity markets. Well, very volatile right now. So with the Federal Reserve interest rates going up over the last 15, 18 months, one can now achieve a relatively good rate of return, essentially risk-free, and that's in Treasury bills or Treasury bills in the short term. Short-term Treasury bills in a year or less duration are paying over 5% interest rates. We haven't seen that since way before the Great Financial Crisis in 2005, 6, 7. Interest rates, as we know them, have been really low for the last 14 years, and that stability of low interest rates has caused a lot of issues, but now the Federal Reserve has to fight inflation. So it comes back to volatility. If you're trying to sift through the various challenges in the marketplace and figure out how to be a better full cycle investor and better advocate and manage your own investments, I've got an opportunity for you. If you've been following me for a while, podcasts, blog videos, newsletters, articles that I publish, and you'd like to get inside my head a little bit more, I don't mean literally, but figuratively inside my head, I do an online Zoom course. I lead it personally. That goes over 4, sometimes we go even 5 or 6 weeks, depending upon the engagement. But it's small group, it's private. And it's a place for you to come where I will take you to a deeper dive on some of the frameworks and concepts that I teach, that I've learned over many years, that I teach in my Freedom Founders group. I'll take you on a deeper dive and make it relevant to you. Because it's a small group, we get to talk personally. The engagement level is high. I want to know who you are. I want to know where you are, where you're stuck, what you're trying to figure out, what you've done, and what you're looking to do. And I can give you guidance that will guarantee you, save you a lot of time, misery, and taking the wrong steps, and very potentially help you make some decisions on investments, practice exits, whatever you're looking at, that can make a big difference in the upcycle of your inflection point in moving towards your freedom, because it's all about freedom. Work is great, but if you don't have a game plan to get you there with a less stress and more peace of mind, then life can be very, very difficult. And my goal is to make it as easy as I can for you. Love to see you on the 30-day blueprint. It's risk-free. Jump in. First 2 weeks, if it's not for you, refund all of your money. No questions asked. I think you'll love it if you've been following me. Take care. The mortgage interest rates, commercial-backed mortgage interest rates, housing interest rates, are packaged together and purchased by Fannie Mae, Freddie Mac, and then sold to long-term investors, institutional investors. They demand a higher interest rate or a higher yield spread than what they could get in the short-term rates right now. Again, I just said short-term Treasury bills are paying over 5% with no risk at all. So if I'm going to invest in longer-term bonds or notes, 15, 20, 30 year, then I'm going to demand a higher return premium. And that's why we see the long-term rates being higher. That's institutions and hedge fund buyers need to have that return to be higher. Otherwise, you just put your money in short term. So short term is paying 5.5%. Got to have at least 7.5%, 8% to make up for the risk. The 10-year Treasury note, as opposed to shorter term Treasury bills, the 10-year Treasury note is what correlates very, very closely to what, say, 30-year fixed rate mortgages will be. If you go back 40 years and just look at the graph, they run in correlation with, again, the mortgage interest rates needing to be higher than the 10-year Treasury, because Treasuries are always considered risk-free, backed by the U.S. government. So anything outside of Treasuries has got to be priced at a premium. So if you watch the 10-year Treasury, which has gone up substantially in the last 15 months, from very, very low to now over 4%, that's a 10-year, then the 30-year mortgage-backed securities have to be priced higher. I don't see investors looking at the ability for the Federal Reserve to control inflation being very certain at this point. And that uncertainty, that volatility, is going to keep pressure on the 30-year fixed-rate mortgages for some time. I think we'll see swings. I think we'll see a point where essentially the Federal Reserve feels like they're getting inflation tamped back down again, but to the extent that that happens, we're going to cause a recession, higher unemployment, which is what they want to see. It's going to cause more problems in the economy, which is going to cause, in turn, the Federal Reserve, probably from a political standpoint, to have to swing back the other way and pump the economy back up again. What's that going to cause? More inflation. So it's going to be a back and forth seesaw for quite some time. Again, meaning long-term investors are not going to take the risk of going out longer term and not pricing in that risk to a higher rate. Why would they? Too risky. It's going to have to stay high. I think we're in a duration period of time where we will not see interest rates really, especially 10, 20, 30-year rates come back down again where they were. I don't think we'll see that again, at least for a long period of time. So people have to get used to it. And in so doing, equity markets will have to be repriced. Real estate, for example, has to be repriced according to the higher interest rates, because the higher interest rates mean that people who are borrowing to buy real estate can't afford the higher prices that we've seen pushed up in the last 3 years. Those values are going to come down. Eventually, we'll hit some equilibrium, but that's where a correction comes into play.